I think the major risk in the markets is that just assets generally are very expensive.
Adrian Day, president of Day Asset Management, discusses ways to protect against inflation.
Equities are an inflation hedge, and frankly, people's own individual businesses can be an inflation hedge. I think gold is a good inflation hedge on a risk-reward basis, because I don't think there's a lot of risk in gold. Silver's probably a better inflation hedge. It historically has been a better inflation hedge, and right now I think it would be a better inflation hedge. I think the problem is that real estate has just got too expensive for most people. So I don't think in a modest inflation of 3 or 4%, we're going to get additional dramatic moves out of real estate. There's a lot of supply of real estate in terms of rental units and so on. So I don't think we're going to get huge response. When I look at commodities, I'm a bull on commodity. I think the narrative of another commodity super cycle is, I haven't called it that, but I don't think it's far from the truth. But that's all based on demand. It's based on continued growth in China. It's based on continued infrastructure spending in China. And it's based on infrastructure spending in the US, some of which we may or may not get. Personally, I like to focus more on individual commodities where you have not only a good demand story, say copper or nickel, where you have the electrification story. As we know, electric vehicles take 4 or 5 times as much copper and nickel as internal combustion engines. Electric utilities use far more copper and steel than do coal-fired plants. So if the whole electrification story is very positive for demand for copper and nickel, but I also look at individual commodities where there's a supply side to the story. And I'm less of a bull in the near term, say on uranium, than some of my good friends are. And that's because there is no shortage of uranium that could come onto the market if uranium sustains a price of, let's say, $50 or $60 a pound. There's a lot of excess supply in Kazakhstan. Same, in a way, with oil. If the oil price sustains itself at $80 to $100, there's a lot of excess capacity, both in Saudi Arabia, but also in America. Now, there's, in the US, of course, you've got political considerations, of course, as well. Joe Biden seems to think that the whole world should produce oil and metals for the US to consume, but we don't actually want to produce them here in our country. But there's excess capacity. It's not a physical shortage. Copper, on the other hand, has much more of a genuine physical shortage. If you look ahead 5 years, copper mines take a long time to come from discovery, certainly decades from discovery to production, but even from a go-ahead decision until they're in production is normally 5 years minimum. So you pretty much know what mines are going to be producing in 5 years' time. There's no major mine that we don't know about that's going to be producing in 5 years' time. And the truth is there's a physical shortage of copper. When I talk about a physical shortage, I'm not talking about the world running out of copper. I'm talking about prices having to go up for demand and supply to come into balance. I think if you look at, say, the year 2000 to 2007 in particular, but also to 2011, that super cycle, that was a super cycle based on the economic growth in China. And when an economy, whether it's China in that period or whether it's frankly Germany in 1870 to eve of the First World War, or whatever period you want to look at, when you have a large economy, industrialize, and you have that sort of emphasis on economic growth, such as we got in China in that 10 years, then all of the things, nickel, zinc, they all go up because the demand from that new source of demand and the demand for all commodities increases. We're not at that stage now. China's past that stage, I think. And I don't think Indonesia or Brazil or India are about to take its place. So it's a much more selective. That's why I hesitate to call it a commodity super cycle, to be honest.
Adrian goes over his thoughts on the major global risks that he sees in the markets.
I think the major risk in the markets is that just assets generally are very expensive. They are overpriced on a historical basis and they're overbased on a valuation basis. Now, that doesn't mean that you're going to have a crash in global stock markets and global real estate and everything else anytime soon. Doesn't mean that at all. But what it does mean is that the risk in those assets just continues to go up. as asset prices go up, as valuations go up, then the risk goes up. And there's been study after study that shows that when plotting every single instance when people bought stocks trading at less than 10 times earnings, which is cheap, over the last 50 years, and they didn't necessarily go up the next year or even the year after that, but over 5 and 10 years they did go up. And then you compare that with buying stocks at expensive multiples, and in this study it was 15 times sales, which again is expensive, and again there was no decline for the 1 year following those purchases, but over 5 and 10 years there was a decline. So the point I'm making is that the risk just continues to go up. And that to me is the biggest risk in the market, because right now the US stock market trading at 2 standard deviations, trading at higher multiples than even on the eve of the great crash in 1929, there is no question that it's overvalued and that there's risk in the market. Valuation does not tell you anything at all about timing. And I like to joke with people, a Dutch tulip bulb in Amsterdam in January of 1636, trading at 25,000 guilders, that was overpriced, but it went all the way up to 37,000 guilders. So you have no idea when the thing's going to end.
Adrian then talks about what can be done to hedge individual accounts for markets with high valuations.
I think you can buy hedges. So one of the things we do for our individual accounts is we bought the VIX, and we bought it as a hedge. In and of itself, it certainly hasn't been a very good investment for the last couple of years. But then everybody says about gold, you don't expect a hedge or an insurance policy to be a good investment. In fact, you actually hope it's not a good investment. But so I think institutional investors can hedge their exposure in that way, and we're doing that.
Adrian discusses the methods he takes to deal with downside risks while participating in the market.
First of all, I don't try to minimize volatility, because volatility is inherent to the gold and silver space. I think if I were a global value investor, I might try to minimize volatility. In the gold space, volatility, as Rick Rule likes to say, make volatility your friend, not treat it as an enemy. Obviously, we're always trying to outperform other funds, and I'm sure other funds are trying to outperform as well. But I think you do that not by necessarily taking additional risks, but I think you do that by trying to focus on what subsector of the market, I'm not even talking about individual stocks now, but what subsector, whether it's the royalty companies or the big miners or the junior miners, etc., which subsector represents the best value and is likely to do best in the next sort of few months. Right now, I'm a huge fan of the big royalty companies. I bought Franco-Nevada 1985 in this first reincarnation. So I've been around this sector all the time. I don't think those are the best value right now. The good quality big miners, I think, are ridiculously cheap right now. And if you look at a company, say like Barrick, which is the second largest gold mining company in the world, on any metric you look at, whether it's price to free cash flow, it's trading pretty much at the lowest it's ever traded. It just doesn't make sense when gold is trading at around 1800. So I think the big cap miners, and there's several of them that are really good quality, have good balance sheets. The balance sheets of the big miners have improved tremendously. The XAU is now net cash positive, which is really quite astounding when you think it's a capital-intensive industry. You should be accepting of debt in the mining sector. The balance sheets are much better than they were, but I think that valuations are ridiculously cheap. When gold turns up, those will be the stocks that people will go to first. The generalist investors, they're not going to buy Ajax Exploration, however cheap it is. They're going to buy Barrick and Newmont and Agnico and so on.
If you found value in this video, please like the video and let us know what other topics we should make a video about next.